Tesla and Alphabet just reported earnings. Both companies are spending aggressively on artificial intelligence and infrastructure, and both produced negative free cash flow during the quarter because of those investments. But the similarities mostly end there. Alphabet is already showing that AI can accelerate revenue and expand profits. Tesla is investing in robotaxis, robotics, energy storage, and manufacturing projects that could transform the company. But many of those opportunities are still at an early stage. I remain bullish on both companies, although for very different reasons. Let's start with Alphabet. Alphabet generated quarterly revenue of $119.8 billion, representing growth of 24% year-over-year. Google search revenue increased 17%, YouTube advertising grew 13%, and operating income increased 30% to $40.8 billion. For a company of Alphabet's size, these are exceptional numbers. But Google Cloud was the biggest story. Cloud revenue increased 82% to $24.8 billion, while operating income more than tripled to $8.8 billion. Its operating margin rose from approximately 21% 1 year ago to nearly 36%. That combination is rare. Rapid growth usually requires companies to sacrifice profitability as they spend on infrastructure, employees, and customer acquisition. Google Cloud is managing to grow faster while keeping more of every dollar it generates. Only a few years ago, the business was losing money. Today, it is becoming one of Alphabet's most important profit engines. Artificial intelligence appears to be driving much of that acceleration. Google said nearly 90% of Fortune 100 companies are using Gemini Enterprise. More than 9 million developers are building with Google's models every month, and its APIs are now processing approximately 22 billion tokens per minute. Cloud backlog also reached $514 billion, increasing by more than $50 billion during the quarter. Alphabet expects to recognize slightly more than half of that backlog as revenue over the next 2 years. Some of the backlog includes direct sales of Google's TPU systems, so it may not all carry the same margins as traditional cloud contracts. However, the number still demonstrates the scale of demand. Google's advantage is that it controls almost every layer of the AI ecosystem. It designs its own chips, operates the data centers, develops Gemini, runs Google Cloud, and distributes AI through products such as Search, YouTube, Android, and Workspace. That gives Alphabet several ways to generate returns from the same investment. Search is already demonstrating this. Investors previously worried that generative AI could weaken Google's core advertising business. Instead, Alphabet says AI features are increasing search activity and helping Google understand longer and more detailed queries. AI Mode has surpassed 1 billion monthly active users, while search revenue still grew 17%. So far, AI appears to be improving Google Search rather than replacing it. The main concern is spending. Alphabet invested $44.9 billion in capital expenditures during the quarter, pushing free cash flow to negative $5.9 billion. Management also increased its full-year CapEx forecast to between $195 and $205 billion, with spending expected to rise again in 2027. Higher depreciation, energy costs, and temporary use of more expensive third-party infrastructure could pressure margins. Alphabet must prove that demand remains strong enough to justify this investment. But unlike some companies spending heavily on AI, Google is already showing measurable results. Cloud growth is accelerating, margins are expanding, search remains strong, and demand continues to exceed available capacity. That is why I remain bullish on Alphabet. Now let's move to Tesla. Tesla delivered a much more complicated quarter. The company achieved record second-quarter deliveries, supported by stronger Model Y demand and improving sales across major regions. Tesla also finished the quarter with its largest vehicle order backlog since 2023. FSD adoption was another positive development. In North America, approximately 55% of vehicles delivered during the quarter had an FSD subscription active at delivery. Tesla now has close to 1.5 million paying FSD customers globally. Growing software adoption matters because it could improve Tesla's margins and create more recurring revenue from vehicles already on the road. The energy business also continues to expand. Tesla deployed 13.5 gigawatt-hours of energy storage during the quarter, an increase of 53% sequentially. Demand for battery storage could benefit from renewable energy growth and the enormous electricity requirements of AI data centers. Megapacks can help stabilize power demand and improve the reliability of electricity supply. However, Tesla's financial results still contained several weaknesses. Automotive gross margin, excluding regulatory credits, declined from 19.2% to 16.3%. Management explained that the previous quarter benefited from temporary warranty and tariff items. After adjusting for those benefits, margins would have been roughly stable. Even so, automotive profitability remains well below Tesla's strongest years. Energy gross margin also fell sharply, from 39.5% to 20.4%. Partly because of warranty costs and the absence of tariff benefits recognized in the previous quarter. Management expects long-term energy margins to settle in the low to mid 20% range. Tesla is also entering a major investment cycle. The company expects CapEx to exceed $25 billion this year and continue rising over the next 2 or 3 years. That spending will support Robotaxi, Optimus, Cybercab, the Tesla Semi, artificial intelligence chips, solar manufacturing, and additional production capacity. Free cash flow was negative during the quarter. Tesla may eventually generate enormous returns from these investments, but many of the projects are not yet producing meaningful revenue. Robotaxi remains the most important example. Tesla said its fleet has completed more than 380,000 fully unsupervised miles without a notable safety incident. The company is expanding into additional markets, and management says unsupervised miles are growing rapidly. That is meaningful progress, but the rollout is still slower than many investors expected. The fleet appears to contain dozens of vehicles, rather than hundreds or thousands, and service areas remain limited. Waymo has already completed significantly more autonomous miles, and currently holds a clear lead in commercial deployment. Tesla executives also acknowledge that scaling Robotaxi requires more than solving the driving software. Regulations differ between cities, operational systems must be established, and new Cybercab vehicles need additional real-world testing before deployment can accelerate. This does not mean Tesla has failed. It means the timeline is uncertain. If Tesla can create a general autonomous driving system that works without expensive sensors or detailed mapping, it could eventually scale faster than competitors. But investors should not assume that rapid nationwide deployment is guaranteed. Optimus is an even longer-term opportunity. Tesla is building production capacity and developing specialized components, chips, and training systems for humanoid robots. Elon Musk believes Optimus could eventually become Tesla's largest product. But management also admitted it may be the most difficult product Tesla has ever tried to manufacture. There is no established humanoid robot supply chain, so Tesla must develop or internalize many components itself. The early production ramp could therefore remain slow. This is the key difference between Tesla and Alphabet. Alphabet's AI spending is already generating substantial revenue and profit. Tesla's spending is creating future possibilities. Robotaxi could become a major transportation platform. Optimus could open an entirely new robotics market. Energy storage could benefit from growing electricity demand. And FSD subscriptions could improve the economics of Tesla's vehicle fleet. But investors are already assigning significant value to those opportunities before they reach commercial scale. Tesla reportedly trades at more than 160 times forward earnings. At that valuation, Tesla cannot remain only an automotive company. It must eventually succeed in autonomy, robotics, energy, or several of those areas at the same time. I remain bullish because Tesla has advantages that are difficult to replicate. It has millions of connected vehicles collecting real-world data. It has experience manufacturing complicated physical products at scale. And it develops much of its software, hardware, and production technology internally. However, the risks are also substantial. Automotive margins remain under pressure. Robotaxi deployment is moving more slowly than earlier expectations. Optimus is still extremely early, and capital expenditures are rising before these new businesses generate meaningful profit. So, which company delivered the better quarter? For me, the answer is clearly Alphabet. Google demonstrated strong growth across search, advertising, and cloud, while showing that its AI investments can already produce wider profits. Tesla demonstrated improving vehicle demand, stronger FSD adoption, and progress across several future projects. But it still needs to prove that its largest opportunities can scale safely and profitably. Alphabet is currently the higher conviction and lower risk investment. Tesla offers greater uncertainty, but possibly more asymmetric upside if Robotaxi and Optimus succeed. I am bullish on both companies, but after these earnings, Alphabet has done more to prove its investment case. Tesla may eventually create the more dramatic transformation, but investors will need patience while the company turns its technological ambitions into commercial results. Thanks for watching. Let me know in the comments which company you would rather own after earnings, Tesla or Alphabet. And subscribe for more analysis of artificial intelligence, technology stocks, and long-term investing.